Hello, today we are going to solve May 2022 paper question number 1, and this is part D. Prepare things that's going to come here. So first one is the revenue. Okay, then we will have cost of revenue. The next one is cost of sales we have to find. For that, first we have opening inventory and then purchases. Then we have less closing inventory, and then we have to do cost of sales. But I also see carriage inwards. Okay, so purchases, and then we also have to add the carriage inwards. So carriage inwards is the money that is paid. Okay, that is paid for purchasing inventory by the business. So we have to add to the purchases cost. So add purchases plus carriage inventory, that is the total purchases that's going to happen. Okay, and then that will give you the cost of sales. After finding the cost of sales, you have to find the gross profit. Okay, before that, so after finding the cost of sales, we have to find the gross profit. So we have to check whether allowance for irrecoverable debt. Okay, if there is an increase, it can become income, else it will become an expense. So let's is 8%, 5% of 8,000. The current trade receivables is 1,000. So there is a decrease in allowance. Okay, current trade receivables. Okay, current trade receivables they have maintained. Okay, they have maintained is 1,000. So current is equal to 1,000. So decrease in provision, it will become an income. Okay, it will become other income. So that is equal to 1,000 minus 400. That's 600. So that is equal to 600 other income. So let's write that. So allowance for irrecoverable debt. Okay, so the allowance for irrecoverable debt is also coming as an other in fixtures. And then apart from that, we have rent and insurance expense. Irrecoverable debt is an expense, advertising is an expense. So we have covered everything. Okay, so we start from here. Okay, all these are expenses. Now let's start putting all of the values here. So first one is the revenue. Okay, the revenue is 570,000. So 570,000. Then we have the opening inventory 61,000. Okay, opening inventory is 61,000. Then we have mention this as pounds here. Okay, everything is pound. Then purchases is 390,000. So 390,000. Then we have the carriage inwards 3,600. Then we have to less the closing inventory. The closing inventory was 72,000. So less the closing inventory. So let's find the cost of sales. So 61,000 plus 390,000 plus 3,600 minus 72,000. So the cost of sales will be around 382,600. So let's write that 382,600. Now we have to find the gross profit. So this cost of sales we have to less from the revenue to get the gross profit. So let's write that also. So revenue minus cost of sales. So that is equal to 187,400. Then we have the other income. So commission receivable. Commission receivable was 6750. So let's write that. Commission receivable was 6750. Then we have the staff wages 57,500. Okay. So commission receivable we have 6750. Then allowance for irrecoverable debt, we know that it got decreased, and the decrease amount now is 600. Okay, so we had calculated earlier from here. Then expenses, carriage outwards is 8,100. So let's add up this other income first before. Okay. So 6750 plus 600, that is 7350. 7350. And that you have to add with the gross profit. Okay, so let's add up with the gross profit. So plus 187,400, so that should be equal to 194,750. So 194,750. Now let's write all the expenses that's going to. Carriage outwards, as I already mentioned, it's paid by the business for delivering the product. Then so that's 8,100. Then staff wages 57,500. So let's write that 57,500. And then we have general expenses. And then we have the general expenses of around 9,200. So let's write that 9,200. Then management salaries were around 38,000. So let's write that. Then we have to calculate provision for depreciation. Okay, so we have to do the working. So let's write here. So provision for depreciation. Okay, so the data given is depreciation is to be charged on all non-current assets owned at the end of the year. Computer equipment is at the rate of 20% by reducing a balance method. But there was an additional computer also that was purchased. Okay, so first one is they are going to be using reducing balance method 20% per annum. The cost is okay of the computer equipment. So reducing balance method, so provision or depreciation expense will be cost minus, okay, accumulated depreciation times the rate. Okay, so that's how you will calculate. Now we know what was the cost. The cost was 50,000 plus 6,000 was bought, okay, minus the accumulated depreciation was 21,000, so times 20%. So let's calculate this. So you add up 50,000 plus 6,000 minus 21,000 times 20%. So the value will be 7,000. So this is how you will calculate the depreciation cost for the computer equipment. This is for the computer equipment. Now you have to calculate for the fixtures and fittings. Okay, fixtures and fittings. So how will you calculate the depreciation cost for fixtures and fittings? So we have they are at the straight line method. So even if you buy, okay, it will not be affected. It is just going to be affected by the cost present. So fixtures and fittings 15%. So 28,000. So the formula for depreciation expense, okay, depreciation expense for fixtures and fittings will be cost times the rate. So that is equal to, so cost times the rate percentage. So the cost is 28,000, okay, times the rate is 15%. So that is equal to, so 28,000 times 0.15. So that is equal to 4,200. So it is 4,200. So this is the depreciation expenses for, okay, this is the provision for depreciation expense calculation for the equipment, for the computer, and this one. So let's write that. So the expenses is 7,000, okay, 7,000, and then fixtures and fittings we had 4,200. So let's write that. Then we have the rent and insurance. So the rent and the insurance expense was 4,800. So let's write that. So it is 4,800. And then we had the irrecoverable debt. Okay, the irrecoverable debt was around 2,850. Okay, 2,850. So let's write that expense also. So 2,850. And then we have the advertising expense. Advertising, there was a newly furnished and a check of 1,800. So advertising equipment was for the for the newly refurbished premises was 2,400. So 2,950, okay, 2,950, 7,950 plus 2,400. So let's write that. So 7,950 plus 2,400. So that is equal to 7,000 plus 7,950 plus 2,400, that is equal to 10,350. So the total advertising expense would become 10,350.